Our next speaker is Ray Wallace. Ray joins us from Tukwanta Asset Management. Ray probably manages the biggest money market funds in South Africa. I love their business model. They basically take corporate and I guess retail deposits. They go to the bank and they drive yields. And that is today's discussion, is optimizing short-term yields. And we're going to be doing a Q&A type session with Ray. So the first question I want to ask is, you know, liquidity is your game. It's where you guys deliver alpha. And maybe you could just explain, you know, what that skill means. I think it's often a skill that maybe not appreciated by the market.
So managing liquidity is very similar to how a bank would manage its business. You know, people would come in and need money when they want it. And the idea is the bank always has to have money available. And a money market fund or income funds are no different, really. What you've got to do is make sure that even if you have massive withdrawals, that you have enough cash or near cash available to be able to honor those requests. But at the same time, you're still trying to achieve you know, competitive yield. So that's where the sort of art comes into it. You know, in the old days, cash management would just be some guy in the back office who didn't make it as an equity guy, sort of, you know, putting money into some NCDs or fixed deposits. But it's very different now. It's become a specialized business, you know, and it caters for a whole range of different types of clients. You've got your retail clients, but then you've also got corporate clients who are very conservative and want to make sure that their money is safe, but that they can access large amounts of cash, you know, at any particular point in time. So it's getting that balance right between yield and conservatism and making sure that the money is safe.
And one of the views that I've often discussed with you, Ray, is that certainly on, say, a core income fund, you have extremely low duration on that fund. Maybe you could just talk us through your philosophy in terms of managing that kind of, you know, it is a I guess a money market plus a small bit of return, and just talk to us through how you actually achieve that without taking on significant interest rate risk.
So, you know, there are two ways of managing cash. You can take duration bets. In other words, you buy fixed rate instruments and you hope that your call on the direction of interest rates is correct. But generally we've over many years that we managed money, 25 years, we've found that to kind of be a mug's game. We've always had the strategy of saying what we want to do is to make sure that we don't lose money because of unnecessary or unexpected interest rate changes. So what we want to do is to focus on getting you returns that are more related to taking time premium alpha out of assets, or by managing the liquidity properly. So we can have longer dated assets with low duration. And the way you do that is to buy floating rate assets as opposed to fixed rate assets, because floating rate assets have their interest rates reset every 3 months. And so the duration you're taking, or the interest rate risk that you're taking, is very short. And what you need to do then, though, is to make sure that you have the right types of assets so that you can add a spread above that floating rate, which is going to pay off over the long term and give you a yield that is going to always outperform a floating rate benchmark, and is going to reward you for the kind of credit risk that you're taking in the fund.
Yeah, so effectively you get your money back every 3 years, and then you have an agreement to...
Well, every 3 months.
3 months.
It gets reset.
Every 3 months.
And the interest rate will go up or go down. So obviously you have it both ways, and you've got to be careful that you know, in cycles, down cycles, you may use less of it. And you may want to put a little bit of fixed rate in your portfolio when you know interest rates are coming down, like after COVID and things like that. But generally, over the last sort of 25 years, a floating rate strategy has really paid off. And we've been able to outperform in all scenarios, whether it's an interest rate up or down cycle.
And that really does speak to, I guess, Sharika is, you know, when you talk to Sharika, who also manages the fund, before she couldn't be with us today, but you know, she talks a lot about generating that excess spread, and a lot of it is that down to hard work on the ground, monitoring the market.
Well, it's down to a number of things. I mean, you know, one of the benefits that Tukwanta has is its size. And size matters in the fixed income space, because the more you have under management, the better you can manage your liquidity, the better access to markets you have, because people take you more seriously. The banks, you know, we're one of the biggest funders of all the banks in South Africa, for instance. So when we make a phone call or we talk to the desks there, they take us more seriously. We're also able to take on entire trades. So we can do private placements with a bank and take out R1 billion worth of instruments. And for that, we get enhanced yields compared to a smaller player in the market.
I hope that gives you a great kind of overview in terms of how to kind of look at investing in money markets and I guess in core income as well. Turning our attention to more market-related issues, what are your expectations for the SARB raising rates this year?
So, we have if you look at the FRA market, the forward rate market, it's quite aggressive, and it's actually showing about 100 basis points till the end of 22. We're a little sort of more muted. We think probably about 75 basis points for the remainder of this year, and then probably about another 100 basis points next year. But it's such a difficult thing to predict because we're sitting with a situation of massive inflation in the major economies of the world, and so you've seen already the aggressive stance to interest rate increases in the US, and probably will be followed by many others. And the problem is South Africa has to keep up with that. So it's really going to be dependent on what happens, for instance, in Ukraine. If there's going to be a war, if there's not going to be, is it going to be protracted or not? What's going to be happening to prices generally because of that? The knock-on effect of the oil price, the knock-on effect of food prices because of Ukraine being out of the market. So there's a lot of what-ifs over here. But we still think that the underlying, all the inflationary aspects of our market in South Africa, it's very much sort of imported inflation, and it's the oil price. So we do think inflation will be able to be kept under control, but the problem is the SARB's going to have to be keeping up with the US moves in increases in interest rates, and so I think we'll be guided generally by what happens in the US in terms of that. But my expectation would be that it's going to be up. And the fact that the portfolio that we manage for Ned Group, whether it's in the money market or in the core income, it's all floating rate instruments. So it doesn't really matter from our perspective how much it goes up. It's definitely going to go up, and we're going to capture 100% of that market increase.
From, I guess, a money market investor's perspective, or even from a core income perspective, the investor might be thinking, what happens if the interest rates I'm earning on those assets is less than inflation? That has to be a key risk. Now, what you've said there is that the SARB is likely to increase rates. So I guess the question is, will the SARB increase rates enough and stay ahead of that curve to ensure that you still get a real return on cash? Because elsewhere in the world, that's not happening. Yields in the US are now negative on shorter dated money market type funds. And that talks to the concept of financial repression. So do you think the SARB will stay on top of that?
I think the SARB won't have a choice but to do that, because you have a situation where you're trying to protect the rand. The only way you can do that is to actually offer real rates in this country. And we've had real rates for a long time up until COVID. And then because of that 3% decrease in rates, your money market rates are only at best managing to keep up with inflation around about 5.7%, and those sort of income funds yielding something like that. Previously, we were yielding in excess of 2% above inflation, and I think to be able to attract money to the country, you do need real yields. So the Reserve Bank really won't have an option but to keep up with the US yields, because otherwise the rand will weaken substantially. Things will just get worse. We'll have much higher inflation, and then the cycle gets quite vicious after that.
Yeah, I think that's an important point for guys that are investing in these shorter dated funds.
But from my perspective, it will be good if we're breaking even at the moment. So in other words, the money income funds are at least achieving inflation. Then it can only get better from here, because I think we will see real yields back again quite soon.
Yeah. Quick question. You mentioned there, you are one of the biggest suppliers of liquidity to the market in some respects. Have you seen an increase in corporate issuance of bonds?
Not really, no. Unfortunately, the economy's been pretty dead for the last 2 years, and even before that, it was there was a lot of corporates that were just sitting on piles of cash, and nothing really has changed dramatically. There's definitely been an increase in demand, on the demand side lately, where a lot of corporates are looking to expand their operations and stuff, but not to the point where we would see large-scale borrowing. And we see that in the banks, because the bank spreads on their, on their borrowing has been very low. I think it went, for a 5-year NCD, for instance, just after COVID, went as low as about 75 basis points, so JIBAR plus 75. We're now seeing it come back, and we're looking at spreads of about JIBAR plus 100, 150. And so you're looking at almost a doubling of those spreads, which means that the banks are now starting to lend. So obviously the corporates are coming to the banks, and then we would expect the corporates to come back to the capital markets themselves directly fairly soon. But I think in a muted way. I don't think it's going to be a runaway situation. So at the moment in the core income fund, for instance, you won't see a lot of credit. It's mainly been the banks, because they're really the only ones that have been doing any lending of late. But hopefully it'll start picking up, and that will also be good for diversification. It'll be good for yields for the fund as well.
Thanks very much, Ray. Really appreciate your time. That concludes the first half of our Nedgroup Investments Q1 Fund Manager Workshops. I will be leaving you now and handing you over to my colleague Ndile. Ndile has recently joined our team, and we're excited to have him on as one of our hosts, and he'll take you through the rest of the proceedings today. There will be a 10 to 30 second break on your screens, but we do appreciate that you will return and enjoy the next segment of the Fund Manager Workshops. From me, Douglas, appreciate your time and all the best.